The trade desk fired its CFO, its CMO, and its head of commercial in the same press release last night, and then watched the stock lose almost a quarter of its value anyway. Good morning. It's Friday, August 7th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks, and today we've pulled Dave Sullivan into the fourth chair because between Trade Desk, Cloudflare, Airbnb, Datadog, and a 900 million share SpaceX unlock, this morning is basically wall-to-wall single-name earnings violence. And in about 2.5 hours, the July jobs report lands and tells us whether the Fed's own dissenters had a point. Grab your coffee. There's a lot here. Dave, welcome back to the chair.
Good to be here. Yeah, when the invite said earnings violence, I figured I better bring coffee, not just drink it.
Board business first, though. Eleanor, you called jobless claims yesterday. Walk it back before we get into anything new.
I did. I said if claims printed above 210,000, that's a third straight cooling data point counting ADP, and I thought the 10-year keeps drifting under 460. If it came in under 200,000, I said yesterday's ADP softness gets written off as one noisy month and yields hold roughly where they are.
And the number?
199,000. Right on my under 200 side. And the 10-year didn't drift lower. It actually ticked up to 467 by the close. Yields held, arguably firmed a touch. I'll take that one.
12-7 now. Streaks at 3.
3 days. I'll take it quietly this time.
Progress.
Marcus, Airbnb was your tiebreak, and it was a real one. Walk it through.
I said if Airbnb's guide implied growth accelerating from this quarter's pace, it trades like Block did, rewarded, not punished, because it adds to the number instead of just meeting it. If it only matched consensus, it gets the Applevin treatment, regardless of how clean the print looked.
What actually happened?
Third quarter guide of 4.69 to 4.77 billion, above the 4.61 billion the street was modeling. Guide extended, stock traded up 9%. That's the win. And it's also the answer to the fight Eleanor and I left hanging yesterday. It wasn't a market-wide repricing of every growth name. It was specific, name by name, on whether the guide adds to the number.
I'll concede the test came back your way. I still think there's something structural underneath it, but you called the mechanism correctly, and DraftKings and Roku didn't hand me a rebuttal either. DraftKings missed the quarter outright. Roku didn't even give guidance. Neither one was the clean test I wanted.
10-9, Marcus. Streaks of 5.
5. I'll take it and not gloat, unlike some people this morning.
I said, quietly.
All right. Actual tape. Start with the close, because after 5 straight record sessions, Thursday actually broke the streak. Eleanor.
Dow fell 464 points, 0.85%, to 53,885. That's off Tuesday's record above 54,000. S&P slipped 0.2. NASDAQ actually held up best, down just 0.1, because chip strength offset a soft tech tape elsewhere. Russell lagged, down 0.6.
Here's the thing. The index moves were genuinely mild. It's underneath the index where Thursday got violent.
Give me the list.
Honeywell Aerospace, down 21% after slashing its 2026 sales growth outlook. Adwhelm Holdings, down more than 33% on a $452 million net loss, and its first ever dividend pause. Datadog, down 15-16%. Peloton, down almost 15% despite beating on earnings. SpaceX, down about 14% despite beating too. 5 names, 5 different reasons, all losing 15% or more in a single session.
While the S&P barely moved, that gap, index calm, sitting on top of stock-level carnage, is a hallmark of late-cycle earnings seasons. Diversification's doing real work at the index level, but it's masking how punishing this environment's gotten if you own the wrong single name.
Is that new, or is that just August?
It's not new that earnings seasons get violent under the hood. What's new is the VIX easing 3% on a day like that, down near 15.25. Options markets aren't pricing any of this as systemic stress. Orderly carnage, if that makes sense.
Which tells you the market's making real distinctions, not panicking broadly. Owens Corning actually climbed 4% the same day on a beat, despite housing headwinds. It's not sell everything. It's sell the miss. Keep the beat.
Eleanor, you flagged something on the internals before we came on air. Walk that in, because I think it actually explains why Thursday looked the way it did.
Right, this is a step back from any single name. Going into Thursday, the S&P's RSI was sitting near 74.5, the Dow's near 74.6, both well past the 70 line that usually defines overbought. Dow money flow readings were reportedly up near the mid-90s. That's extreme by either measure.
But breadth was genuinely healthy underneath that, right? That's the part people skip.
It was. Over 70% of the S&P was above its 200-day moving average heading in. New highs were beating new lows on both the NASDAQ and the New York Exchange by multiples. That's broad participation, not a narrow mega-cap sprint.
So which is it, healthy or stretched?
Both, and that's the point. Good breadth and an overbought oscillator aren't contradictory, they're sequential. Broad, healthy advances are exactly what push RSI into extreme territory in the first place. Thursday's stall reads like the first crack of a digestion phase, not the start of something worse. A market that's overbought with deteriorating breadth, narrow leadership, highs shrinking, that's the setup that precedes real trouble. That's not what we had.
Which is basically a long way of saying Thursday was overdue, not ominous.
Overdue's fair. I'd stop short of calling it nothing, though. A market sitting in greed territory on sentiment gauges, with a Dow that's ripped 5 records in 6 sessions, doesn't need much of an excuse to take a breather, and it just got 5 of them at once.
Fine. We'll call that context, not a verdict. Dave, you've been quiet. Anything to add before we move off Honeywell and the rest of that list?
Can I jump in on Honeywell Aerospace because that one's not really my beat, but the mechanism is, that's the same guidance-only story we've been hearing all week from AppLovin and HubSpot, just wearing an industrial costume. Guide cut to 4 to 5% from 7 to 9, stock gets crushed 21%, same disease, different sector.
Which is sort of my whole argument from yesterday, just restated in industrials.
Noted. We're not relitigating that one, we already scored it. Let's talk about what actually piled onto that pattern last night, because the after-hours session added 3 more names to the pile. Trade desk. Dave, why was this the ugliest print of the night? Not just the biggest drop.
Because it's not just a number, miss, it's a structural admission. Revenue came in at $715 million against a street number of $751. Adjusted earnings of 34 cents missed the 40-cent consensus. Growth decelerated to 3% year over year. This is a company that was compounding above 20% not that long ago.
3%. That's not a deceleration. That's basically stalling out.
And the guide made it worse. Third quarter revenue guided to at least $650 million, which is a step down from second quarter's $715. Sequential deceleration, and it's not stabilizing.
And the leadership news on top of that.
Same release. CFO, CMO, and their commercial chief all replaced at once. When you announce a guidance cut and a management purge in the same breath, you're telling the market the growth problem is structural, not a one-quarter blip. Stock tested fresh multi-year lows after hours.
Meanwhile, Cloudflare, same night, adjacent sector, cloud security instead of ad tech, jumped 17% purely on guidance. Full year and current quarter both guided up, and the market rewarded a business showing no sign of the enterprise spending slowdown other names have flagged this season.
And that one I'll actually vouch for, beyond the headline, since it's closer to my beat. The enterprise spending slowdown worry has been hanging over every cybersecurity name for 2 quarters now, on the theory that AI coding tools shrink the seat counts these platforms sell into. Cloudflare guiding up on both the year and the quarter is a direct answer to that worry, not just a clean print.
Which is exactly the defensible spend side of the split we keep circling back to. Nobody's cutting their security budget to fund an AI pilot. They might cut their open web ad tech budget for one.
And Airbnb, which we already scored.
Right, the one that closes the loop. Beat on both lines, EPS, $1.37 against $1.25 expected. Revenue $3.61 billion. Gross booking value up 16%. Guide above the street, up 9%. Extends the number, gets rewarded. Textbook.
And DraftKings and Sweetgreen rounded out on the other end. DraftKings missed revenue outright, $1.44 billion against $1.51 expected, swung to a 14-cent loss against a 2-cent profit estimate. Sweetgreen dropped almost 17% on a revenue miss and a wider-than-expected loss.
So 5 names. One night, what's the actual line separating the winners from the losers? Sector, like ad tech versus cloud security, or something else?
Not sector. Cloudflare and Trade Desk are basically adjacent businesses selling ad and infrastructure services to similar customers, and they had opposite nights. is whether the thing you sell is something a customer can cut in a budget review. Security's not discretionary. Ad tech spend against open web inventory in a world where retail media and walled gardens keep taking share. That's exactly what gets cut first.
Airbnb and DraftKings make the same split on the consumer side. Travel demand held up. Discretionary betting spend on a promo-heavy business model didn't.
So the read heading into today is
Pricing power and defensibility are getting rewarded. Growth headlines alone, not so much anymore.
we'll take that as the working thesis into the next several weeks of earnings. Before the one I actually want real time on, Marcus, you still owe the desk coffee from 2 rounds of losses. Given this morning's scoreboard, does that debt grow or shrink?
It shrinks. 10-9 beats 9-9. I'm choosing to focus on the momentum.
I still take mine black.
I'll take a cortado, since we're apparently doing orders now.
Noted for whenever Marcus actually pays up. Oh right, real talk. Datadog. This is the one that doesn't fit the pattern we just described, and that's what makes it interesting. Eleanor, set it up.
Datadog beat on every number that should matter. Revenue, $1.12 billion, up 36% year over year. That's an acceleration, not a deceleration. EPS of 65 cents against 58 expected. They raised full-year guidance on both the top and bottom line, and the stock still fell 17%.
Why?
Because buried in the forward commentary, their single largest customer, understood to be OpenAI, is pulling back usage starting next quarter, and the resulting guide implies sequential revenue growth nearly stalling under 2% 1 quarter after an 11% sequential jump. That's the story. Not the quarter, the warning.
And the number underneath that warning is worse than people are giving it credit for. Our reporting has OpenAI at something like $300 million of Datadog's revenue and roughly 90% of their entire AI-native customer segment. That's not diversified exposure to the AI trade broadly. That's one relationship doing almost all the work in one segment.
I'd push back on how much that should matter to the stock overall, though. Strip that one customer out, and what's left is genuinely the healthiest core business Datadog's had in years. Net revenue retention holding in the low 120s, new enterprise bookings more than doubling, and non-AI customer revenue growth actually accelerating into the mid-20s%, up from 23 the quarter before. That's diversification working exactly the way you'd want it to.
Sure, but the market didn't sell the core business, it sold the AI story, and the AI story is what's been carrying the multiple. If the market's now pricing AI-native bookings from a handful of frontier labs as lower quality, more volatile revenue than core enterprise subscriptions, even when the underlying business is accelerating, that's not noise, Marcus. That's a repricing of every AI-native software name that leans on the same 3 or 4 customers.
Same 3 or 4 customers means it's containable. This is Datadog's OpenAI relationship specifically, not a sector-wide customer concentration crisis. You need more than one company disclosing this before you call it structural.
Marcus, before you dismiss it, Steelman Eleanor's case for me. What's the strongest version of this is structural, even if you don't buy it?
Fine. The strongest version is that every AI-native software vendor built its growth story this year on a tiny handful of frontier labs who are themselves burning investor cash, not revenue, to pay for the tools. If even one of those labs decides to build in-house instead of buying, which is exactly what OpenAI is doing here, every vendor with a similar customer list has the same air pocket sitting under their multiple, whether they've disclosed it yet or not. That's the real bear case. I still think it's early to call it, but that's the honest version of Eleanor's argument.
Thank you. That's actually the case, yes.
Give me a level, Eleanor. What would prove your side of this, not just a vibe?
If 2 more AI-native software names report in the next couple of weeks and disclose the same kind of concentration risk, one customer or a tiny handful driving most of their AI segment growth, and the market punishes them the same way, regardless of the headline beat, that's the pattern confirmed. If Datadog stays the outlier, Marcus is right that it's contained.
I'll take that test. Snowflake and MongoDB both report inside the next 2 weeks. That's your actual scoreboard, not this morning's.
For what it's worth, from the tech side, I don't think this result's clean either way. RPO, that's remaining performance obligations, basically the contracted revenue not yet booked, grew 43% year over year but declined sequentially for the first time in years. That's a real deceleration signal sitting right next to the acceleration story you're both citing. Both things are true in this print.
Translate RPO declining sequentially for someone who heard billion-dollar beat and tuned out at the acronym.
It means the backlog of already signed future business, not just this quarter's revenue, shrank a little instead of growing. Revenue this quarter was great. What's already lined up for next quarter got a little thinner. That's usually the number long-only investors watch before the headline print.
To be fair to the bull case here, though, the AI cohort itself is still broad. Over 750 AI native customers, 31 of them spending more than $1 million a year, 8 above 10 million. That's not one company propping up the whole segment, even if it's the biggest name in it.
MCP tool calls, that's how AI agents actually query to Datadog's platform, are up more than 22-fold since the fourth quarter of last year. So underlying usage of the product by AI workloads broadly is genuinely exploding. It's just that the dollars attached to the single biggest workload are about to shrink.
Which is precisely why I don't think this is the AI story is fake moment. It's the AI story's revenue is lumpier and more concentrated than the growth rate alone tells you moment. Both of those can be true.
So we've got a genuine split, and I'm not going to force a resolution. Eleanor sees a concentration risk story that could spread across AI native software. Marcus and the RPO number both say it's specific to Datadog's one relationship. Snowflake and MongoDB in the next 2 weeks settle it for real. Hang on to that.
Fair.
Agreed. Genuinely don't know how that one lands.
SpaceX. We left this one unresolved yesterday too, before the unlock actually hit. So what did we learn?
We learned the overhang was real, not just theoretical. 911.5 million shares, something like $123 billion of stock, became tradable, and the stock fell about 14% on the day, despite beating estimates.
Which is closer to my worry than yours, if we're being honest. I said a stock already down more than 45% from its June high with a live bear case about cash burn. Getting 900 million freshly tradable shares dropped into that same conversation wasn't a great combination. 14% down on a beat is exactly that combination playing out.
I'll take that one landing more your way than mine. Though, Dave, you track this stuff in real time. What are you seeing into this morning?
A couple of the desks that cover the name are actually framing it as more constructive than the headline drop suggests. One take going around is that most of the unlocked supply was always going to hit the market because the holders have such a low-cost basis and such long holding periods. So once it clears, that specific overhang is just gone. It doesn't recur. And there's reporting the stock bounced off its worst intraday lows before the close, which reads like some of that supply already got absorbed rather than sitting there threatening more selling into today.
That's fair on the mechanics. It's a one-time clearing event, not a recurring drag, and Musk's own shares stay locked until next June regardless. So this was never about insider distrust in the founder.
So where does that leave it? Worse than expected, or working through as expected, just faster and uglier than anyone wanted?
Honestly, closer to the second. 14% on a $123 billion unlock isn't nothing, but it's not the disorderly dump some people were bracing for either.
I'd watch today's volume before calling it fully absorbed, though. One session isn't enough to know if the sellers are done.
Let me push the other way for a second, just to test it. What if the whole one-time clearing event red is wrong? And this is just the first of several waves, given the December unlock is still out there.
It's a fair worry, but the December date is the full employee unlock, a different and much bigger pool, so today's crowd and December's crowd aren't the same sellers on the same clock. I wouldn't extrapolate today's 14% onto that date without a lot more information between now and then.
Agreed. That's a bridge recrossed in December, not this morning.
Fair. Moving pieces, not a settled story. Last thing before the calls, today, and let's start with what the tape's actually doing right now before we get to the report itself.
Futures are barely breathing. Dow futures down about 0.06%, S&P basically flat, NASDAQ up 0.2. Nobody's taking a real position into a number this uncertain.
Which makes sense given the range on this thing. That's not a market with conviction. That's a market standing at the door with its coat on.
I like that. Jobs report, 8:30 this morning. Eleanor set the stakes.
This is the number that actually settles what ADP only hinted at Wednesday and claims confirmed a little more yesterday. Consensus is split. The Wall Street number's 83,000, FactSet's at 100,000, and there's real dispersion underneath that, down to 18,000 on the low end from one bank. Unemployment's expected to hold at 4.2%.
And there's a wrinkle that makes today different from a normal jobs Friday The Fed just held rates at 3.5 to 3.75 on July 29th, and that decision carried a three-way dissent from regional presidents who wanted to hike, not cut.
Wait, they wanted to hike in a month where the labor data's been coming in soft?
That's exactly the tension. If today's print comes in weak, it hands the doves more ammunition for a September cut. But it also validates the argument that the economy is genuinely cooling, not just normalizing, a very different, less comfortable story than inflation's beaten time to ease.
Whereas if it comes in strong, or even just in line, it's a pretty direct rebuke to the hawkish dissenters, and probably gets read as risk on almost by default, because it removes one more excuse to delay a cut.
So a bad number is bad news, dressed up as good news. And a good number is good news mostly because it isn't complicated.
That's roughly it, yes.
From where I sit, the interesting read-through is less the headline print and more whether tech actually gets to celebrate a soft number, because a lot of these AI infrastructure names live and die on rate expectations right now, given the debt load they're taking on to fund the build-out.
So walk me through the wage piece too, because payrolls isn't just a headcount number.
Right? Average hourly earnings matter just as much here. If wage growth comes in hard alongside a soft headcount number, that's the uncomfortable combination for the Fed, slowing jobs and sticky wages at the same time. And it makes the September cut a much harder sell to the hawks who just dissented for a hike.
Whereas soft headcount and soft wages together is the clean story, cooling all around, cuts easy to justify. That's actually the scenario I think the market's hoping for this morning, more than a strong number.
So it's not just beat or miss. It's beat or miss on two numbers at once, and the combination matters more than either alone.
That's right. Watch both lines when it drops, not just the top one.
All right, let's make this checkable. Closing calls. Eleanor, you first.
Payrolls 830. If it principal is 60,000, I think the 10-year drops through 455 by the close, because that's a real confirmation of the cooling story on top of claims and ADP both. If it comes in at or above the 83,000 consensus, I think yields actually creep back toward 470, because it undercuts the September cut case the market's been building all week.
Marcus.
Same data point, different asset. If payrolls miss badly, call it under 50,000. I think the Nasdaq rallies into the close on rate cut hopes, regardless of what it means for the economy underneath. Because that's how this tape's traded every soft data day this summer. If it beats or comes in line, I think it's a quiet, unremarkable session for tech, because there's no fresh catalyst either way.
Dave, you're new to this chair, so one call, make it count.
Mine's not about the jobs number, it's the Datadog fight we just had. My call, at least one more AI-native software name discloses meaningful single customer concentration risk in its next earnings report, inside the next 2 weeks. If that happens, this was the start of a pattern, not a one-off, and Eleanor's side of that argument wins. If nobody else discloses anything like it, Marcus is right that it's just Datadog and OpenAI.
3 checkable calls, one on the 10-year, one on the Nasdaq, one on the software sector generally. Here's the morning in one breath. Trade desk collapsed 22% and purged 3 executives in the same release, while Cloudflare and Airbnb both blew out their nights on guides that actually extended the number. That split between defensible spend and discretionary spend is the story of this whole earnings season. Datadog beat and raised and still fell 17% on concentration risk tied to one customer, and Eleanor and Marcus aren't settling that one this morning. Snowflake and MongoDB do it for us over the next 2 weeks. SpaceX absorbed its first big lockup unlock at a cost of about 14%, closer to Eleanor's worry than Marcus's hope, though the mechanics suggest that specific overhang doesn't recur. And in about 2 hours, the July jobs report either hands the Fed's dissenters a win or hands the doves their September case. We gave you the levels. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and catch our live takes all day at Nova Ventures CEO on X. That's your Friday morning brief. Have a great day, and we'll see you tomorrow.